Have you ever looked at a business deal and just wondered how? How does a company suddenly become worth thousands of crores seemingly overnight? Well, today we're pulling back the curtain on a fascinating story that shows you exactly how it's done. Let's dive in. 3,000 crores. That is the massive, eye-watering number at the heart of this entire story. It's the expected sale price for a company that literally didn't exist a couple of years ago. To give you some perspective, that's about 360 million US dollars. It's a truly staggering amount of money. So, right off the bat, this leads to the big question. How is that even possible? I mean, really, how do you build a business from absolutely nothing and make it worth 3,000 crores in just 24 months? Well, it's not magic. It's actually a masterclass in modern finance. Okay, so let's start with the big news, the event that got everyone talking, this sale itself. So the headline is pretty straightforward. A major Indian private equity firm called Kedaara Capital is getting ready to cash in. They've officially put their health and wellness manufacturing company, Universal NutriScience, on the market. Let's break down who's who in this whole thing. You've got Kedaara Capital, they're the ones selling. The company being sold, the asset, is Universal NutriScience. And to make sure the deal goes smoothly, they've hired the giant investment bank Jefferies as their advisor. It's a classic setup for a really big, high-stakes deal. But to really understand that huge valuation, we have to rewind the clock. Because this isn't just a story about selling a company. It's about how it was so brilliantly built in the first place. And here is the key to the whole thing. Kedaara Capital didn't just go out and buy an existing company. Nope. They used a classic buy and build strategy. They spotted potential in two completely separate businesses and had this vision that if combined, they'd be worth way more as a single powerhouse. And just look at the speed they moved at. It's incredible. In early 2022, they snapped up the regional assets of a company called Nature's Bounty. Then, just a few months later, they did what's called a carve-out, which is basically buying just one specific high-value piece of a bigger company, in this case, the soft gelatin business from Strides Pharma. By the end of that same year, boom, they'd merged both into a brand new company, Universal NutriScience. So you can really see the transformation here. On one side, you have these two separate, maybe even overlooked assets, and on the other, you have this unified, powerful new player. This new company is a CDMO, a contract development and manufacturing organization. All that means is it helps other brands create and produce their own health products. They literally created something bigger and more valuable than the sum of its parts. Now, a move this slick wasn't just a one-off stroke of genius. It comes straight out of what's known as the private equity playbook. So let's take a second and break down what that actually means. So what in the world is private equity, or PE? Well, in the simplest terms, these are firms that take money from investors to go out and buy companies. But they don't just hold on to them. Their whole goal is to improve the company, make it way more valuable, and then sell it for a big profit a few years down the road. Honestly, the best way to think about it is like flipping a house. A PE firm looks for a company that has good bones, but is maybe a little undervalued or needs some work. They renovate it by improving how it runs, or, like in this case, by merging it with another business. And then, once all the work is done, they sell it for a much higher price. It really all boils down to a pretty simple three-step process. Step 1 is buy. You find those promising assets. Step 2 is grow, which is exactly what Kedaara did by smashing two companies together to create something bigger and better. And finally, step 3 is sell. That's the exit, where you finally make your money. And that brings us right back to today. Kedaara Capital has totally nailed steps 1 and 2. So now let's look at the numbers behind step 3, the big exit. For the investors who put their money into this, the exit is everything. It's the finish line, it's the moment where all that hard work pays off, and the company's value on paper gets turned into actual, real cash. So how much did it cost Kedaara to pull this whole thing off? Well, reports suggest that their total initial investment for both acquisitions was somewhere around 550 crores. Now keep that number in your head, because this is the number they're aiming for now. A sale price of 3,000 crores. Just think about that. From a 550 crore investment, they're looking at a potential return of more than 5 times their money, and they did it all in about 2 years. It's just wild. This chart just puts it all into perspective, doesn't it? You can see the initial investment on the left, and then this huge tower on the right, which is all the value they created and are now hoping to cash out on. This is a perfect textbook example of a home run in the world of private equity. But why does this one deal matter so much? Why are we even talking about it? Well, because this is bigger than just Kedaara. It's a pretty strong signal about the entire Indian business landscape. You see, a sophisticated buy and build strategy like this, followed by such a massive exit, it really shows how mature and advanced the private equity market in India has become. This isn't just about simple investing anymore. It's a sign that complex, global-level financial strategies are creating huge value right here at home. And Kedaara is definitely not alone. This is part of a much bigger trend. I mean, look at this list. We're seeing huge private equity exits across all kinds of key sectors. You've got Blackstone in real estate, Bank Capital in banking, Advent in pharmaceuticals. This is fundamentally reshaping who owns and grows major Indian companies. And that leaves us with one final really important question to think about. This model of buying, building, and selling companies at incredible speed is becoming the new normal. So as this trend picks up steam, what does it mean for the future of how businesses are created and owned in the long run? It's definitely something to keep an eye on.